From the campus of Yale University, this is Business Talk with Jim Campbell, nationally syndicated across the country on the BizTalk Radio Network, and coming to you from our flagship stations, Yale Radio WYBC and 1490 AM WGCH Greenwich. All talk and all business, 60 minutes of radio with leading figures from the world of business along with the business of politics and sports. The tragic downfall of the Consumer Financial Protection Bureau, the inside story from a former CFPB enforcement lawyer talking about one of the key pieces of the Dodd-Frank Wall Street Financial Reform and Consumer Protection Act. And that's today on Business Talk with Jim Campbell. Ronald Rubin was an enforcement attorney at the Consumer Financial Product Bureau, and prior to that position, he was senior counsel and chief advisor on regulatory policy for the House Financial Services Committee. It's on our show a couple of years ago now to talk about the infamous Wolf of Wall Street. And his just published article in the National Review is The Tragic Downfall of the Consumer Financial Protection Bureau. Welcome back after 2 years, Ron.
Thanks. Good to be here. And just you got the order a little bit off. I was actually at the Consumer Financial Protection Bureau before I was at the House Financial Services Committee.
Oh, I didn't realize that. And you're no longer there at the House job, right?
Right, exactly.
Okay. And it was what you've written is obviously a gutsy sort of inside, almost whistleblower account. Before we dive into that, give folks who may not know exactly what the Dodd-Frank Consumer Financial Protection Bureau even is.
Well, the Dodd-Frank Act was passed. It was a much longer piece of legislation passed after the financial crisis to address a lot of issues, and about a quarter of the law was creating this new agency that was just dedicated to enforcing consumer financial laws that, in a lot of cases, other agencies used to enforce.
And basically, in layman's terms, things like revealing the fine print in a lot of products or mortgage or stuff that may look incomprehensible, simplify credit disclosures. Is that correct?
Yes. The original, Elizabeth Warren in 2007 published now kind of a legendary article calling for an agency that would make sure that people understood their financial decisions. So when you're taking a mortgage, that you understand what it is, payday loans, car loans. That was really the entire proposal. But what it ended up being was discrimination laws, mortgage laws, debt collection laws, and altogether there's 18 or 19 statutes that they enforce. So it ended up being much, much broader than the original intention. So what you described was correct, but as it turned out, was only a small part of what they now do. Now,
before we dive into it, did the idealism was it of an agency like this? Was it destroyed by the swamp?
That's a pretty good final wrap up. I mean, one of the points that I make in the article was that structuring it this way almost guaranteed that it would end up being a political organization instead of a professional organization. When I came to Washington to help build this, I thought that basically we were building a similar version of the Securities and Exchange Commission, where I had previously worked earlier in my career for 7 years. But it ended up, and at this moment I would say it still is, much more of a political agency than it is a professional agency.
So the structure is very unusual and puts the director particularly in a hugely powerful position. He's appointed and funded independently of Congress, right?
Yes. Well, he's appointed by the president and has to be confirmed by the Senate. So unlike other agencies, which is what there was a recent case, which you'll probably ask about later, this is one of those rare cases where it's an independent agency that's not headed by a commission. It's headed by one single director who's appointed by the president. And once he is appointed, even the president can't remove him, except for cause, for if the inefficiency, neglect, and malfeasance in office.
Makes him one of the most powerful people in Washington, right?
Right. And then the other, and then what's kind of the icing on the cake is the other way that Congress, if they're from the other party or doesn't like the, agency or at least wants to control the agency, they can cut their funding. And so what they did was they funded it through the Federal Reserve, which is a bank, and earns its own profits and doesn't get money from Congress. So basically Congress can't cut their budget, which is how they might rein in another, an agency that they didn't like. So it's between those two factors, they really answer to almost nobody.
Sounds like Senator Warren's pretty smart. Whoever was behind that structure. All right, what I want to do, I think, would be a good place to start because everybody knows about this. Wells Fargo just had a huge scandal. 2 million unauthorized bank and credit card accounts were opened without the customers knowing that. That would seem like a classic CFPB case. What was their role in it? It
looked like that at first, and the way it rolled out, which, by this point with the CFPB, they're still so focused on everything is the headline and, what's it going to look like. And so if there was that kind of fraud was exactly what the Bureau was formed to stop. But what in fact happened was for 2 years they were going into the bank with their examiners, looking at everything, and if anybody noticed it, and as far as I know from the examiners I've talked to, nobody really seemed to catch it. But if they did, they didn't think it was worth addressing. And then at the end of 2013, the Los Angeles Times ran a big article expose, and it caught their attention because some of the employees who felt they were fired because they were not opening enough accounts sued Wells Fargo. And so when the lawsuit came out, and I guess one of the people, the plaintiffs, called the newspapers, somehow that got to them, and they did a very lengthy, in-depth article. Now, at that point, you would think, okay, well, the CFPB definitely knows about it now. They're going to stop it. But, in fact, they let the Comptroller of the Currency and the Los Angeles City Attorney lead the investigations, and the CFPB went off and did something else, and, whatever else they were doing. And after about 3 years, when it was all over, they came in, and because the Dodd-Frank law gives them so much more leverage to assign penalties, they negotiated the largest penalty of the three of them. So theirs was $100 million. The city attorney, I think, was $50, and comptroller was $35 million. And so the news stories rolled out, and the lead story was Consumer Financial Protection Bureau protects consumers, stops this fraud. But in fact, they really just came in at the end and negotiated the biggest fine. And not only that, but the $100 million didn't go to consumers. The $100 million went to the CFPB or the Treasury or, whatever penalty monies goes to the Bureau.
Yeah, that stunned me. Only $5 million went to consumers?
I think less than $5 million. Probably $2 or $3 million. Now, the reason, perhaps if you want to try to, I'm not defending them, but if you want to kind of explain the way that played out, was that a lot of the accounts were opened and closed, and the consumers never knew it. And it's a little bit hard to say, well, what was actually the harm, the financial harm? I mean, obviously, it's just generally terrible. People should not be able to open accounts in your name. But the question was, what was the quantifiable harm to consumers? And the real harm would be if you went out to get a mortgage, and because you had opened other credit card accounts or bank accounts or whatever, your credit score went down.
Yeah. And
you would end up paying a higher mortgage interest rate on your mortgage for many, many years to come. So the harm was probably much more than the 2 or 3 million that they calculated.
Yeah, I would think they would be liable, able to get civil damages like that for really what's fraudulent abuse. But your main point, though, is that while this should have been at the heart of the CFPB mission, they really basically just came in at the end and took the credit.
Right. And
the money.
Well, and, the theory is, and if you want to say, well, you're protecting consumers, you're saying, okay, well, this huge fine will stop banks from doing this in the future. And if you saw the way it played out, you have to, first of all, keep in mind, $100 million is a lot of money to the average person, but to Wells Fargo, it'll make 1 quarter's profits not look so good. It won't destroy the $100 million in and of itself won't destroy the bank. And
no, for instance, J.P. Morgan paid $30 billion in mortgage, from the mortgage scandal.
Right, right. I mean, and if you just literally look at it as, okay, well, that's $100 million less profits in 1 quarter, but the stock price was totally destroyed because basically a lot of people lost faith in the bank and, were saying, well, should I keep my money in Wells Fargo anymore? And then on top of that, the head of the bank came in and didn't convince Congress and didn't basically stop the bleeding. And so he got fired. And between him and the woman who was running the incentive programs, they had to give back $60 million. That's what will make the next bank executive make sure he's careful.
That's a good way to end the first segment. You're listening to Business Talk with Jim Campbell of the BizTalk Radio Network, 350 stations around the country. Go to the biztalkradio.com, find the station nearest you, listen over the Internet, access our podcast. We're going to get into some of the specific complaints and faults that sort of, in your opinion, help destroy the agency as soon as we get back. And we're back with Ron Rubin, formerly enforcement lawyer at the Consumer Financial Protection Bureau. Now, you have a bunch of specific sort of complaints, some of them almost of a whistleblowing nature, really, in scope. Why don't we talk about some of those and maybe, from the most, in your mind, the most important and down? I know that you talk about internal discrimination, illegal hiring, and no real Republicans there. What do you mean by that?
The point was not so much to be a whistleblower, and I'm certainly personally not complaining about anything, but it's that to understand the story, you have to know what went on. And the first most important thing to understand about the agency, which is really just very, very unusual, is that if it were up to them, there wouldn't be a Republican in the building. So I kind of have to tell the stories about how you got to that point, because you couldn't put on the job description Republicans need to not apply. So it was kind of the process of how that happened and how they were able to keep Republicans out. And that's really the nature of why I was telling those stories. That and the fact that some of them are actually kind of funny, the way it plays out in the actual hiring meetings and things like that.
And is this what you mean when you talk about internal discrimination and illegal hiring?
There was other kinds of discrimination later on, which came out after I'd left the Bureau. There was a report that showed that their own internal employee review system, that minorities actually performed worse in the performance review system, which is under the disparate impact theory, which says you can just look at statistics alone. That would mean that they were discriminating, by their own terms and by the CFPB's own terms that they impose on the auto industry and other lenders. So that was a kind of a second step in the discrimination, was that further down the line, that internally that a lot of minority employees felt like they were being discriminated against. And it's a tough question to say whether it's intentional discrimination or whether there's just kind of cronyism going on the inside. But so, for example, I can tell you, around the time all that came out, I asked one of my African-American attorney friends who was still there, well, are they really discriminating? I mean, is that possible? And he said, well, you talk about cronyism. If all the people you promote and the people you give good reviews to are your friends, and all of your friends look like you, when does that become discrimination? So it's a lot of times it's hard to draw a fine line between why something is happening. But clearly, many of the employees feel like that there was discrimination. And in fact, in the congressional hearings at that time, one of the former attorneys, who actually I had worked fairly closely with back in the day, she testified that there was an area of the Consumer Financial Protection Bureau consumer response that the employees themselves nicknamed the plantation. And they did because they said, well, once you're working on the plantation, you never get off the plantation, and everybody who works in the plantation is an African-American man. So, there were some real kind of internally that the employees felt like they were being discriminated against. And one of the issues was that on a numbers basis, there were the correct distribution, but the employees who were the minorities were being given the worst job, the lowest level jobs in the Bureau. So,
okay. Now, when you talk about no Republicans, it implies maybe an ideological, liberal, whatever you want to call them, a Democratic bent. did that translate into, basically trying to extortionate and bullying of businesses?
Yeah, well, I mean, part of it was that the way the law set the agency up, first of all, you had no, political oversight. So they could kind of do whatever they wanted. And part of the law had this thing called unfair, deceptive, and abusive acts and practices, which really it left it up to the Bureau to decide what that meant. So it was very subjective. So really the Bureau could almost charge you anything they wanted. And the only thing that was kind of constraining them was their own conscience. And so when you had, over time, all of the moderates kind of left. They were kind of not wanted in one way or another. And you had, at the end, as time went on, a very singular, very left-wing view, not an intellectually diverse view of issues. And so... very
anti-business, to be blunt.
Yes. Well, somebody once said to me, someone at a bank once said, it's not that the CFPB doesn't like banks, they just think banks shouldn't make a profit.
And further, their ability to bully, you say that unlike the SEC, which had due process through Wells notices, so you knew if you were targeted, the Bureau here didn't even allow it, it sounds like, or made it very difficult to give someone a fair chance before he had to go spend huge legal bucks.
Yes, yeah, and I actually, having worked at the SEC, I actually was kind of one of the leaders in writing those processes for the CFPB because I had experience with them. So I actually wrote the internal procedures, and I knew what the rules were, which the world didn't know. And when it came time for one of my own clients to take advantage of that, they just said, "No, we think it doesn't work for us." They didn't follow their own rules. They said, well, it's discretionary. We don't have to give it to you. And we don't think it's in the Bureau's interest. And the point was, well, we're not talking about the Bureau's interest. We're talking about the defendant's interest and having a fair chance to tell their side of the story. So, yes, I mean, they at some point, and I talk about this in the article, somebody said to me, well, they set up these rules so that you didn't actually have to give the other side things that might have helped them, exculpatory evidence. And as a former prosecutor myself, I just was shocked by that. I thought, well, obviously, if you have an ethical obligation to give the other side evidence if you don't think they're guilty or you know that they're not guilty, and they didn't view themselves that way. They said, we're just like civil litigants. We're like anybody else in a lawsuit, and we don't want to give the other side things that'll
sort
help.
of like almost a rogue agency. You use the term choke points as part of them going after bigger businesses. What do you mean by that?
They would pick basically the biggest businesses to make the biggest headline, to make the biggest splash. And this was another kind of part of what ultimately disturbed me a little bit, was that they didn't choose companies because they had done the most wrong. They chose them because of who they were, because they were the biggest. And if you look at the most obvious kind of analogy, that's, if you pull somebody over driving, if a police officer pulls over someone because they're African American, you're outraged. You're saying, what do they call that? Driving while black. But when you do that to a business, when you say we're gonna go after you because you're the biggest, not because you're the worst, then you're going after them because of who they are, not because of what they've done. And that, I always found that to be very disturbing.
Pretty amazing stuff. In the remaining about 30 or 40 seconds, something that always bothered me is there didn't appear to be cost-benefit analysis done in terms of that, and such as even having a business perspective to look at both sides when you went after a business.
No, it was a view of the world that didn't have that rounded perspective because they viewed people who were, let's say, Democrats, who had worked in private practice and represented the banks, well, gosh, they were sympathetic to the banks or financial companies or whatever. So if you don't have those people, you also don't have their perspective and their experience and their ability to tell you why something wasn't wrong.
Too much power, it sounds like. We'll be right back. More on the CFPB. Ron Rubin, our guest. He is the author of a long and fascinating insider take of the tragic downfall of the CFPB, as he calls it. The National Review is where the article is. Talking about what is sort of appears to be clearly an abuse of power. There was a recent ruling, a PHH ruling, that even found the structure unconstitutional. Talk about that.
from the very beginning, there were a lot of people who were arguing the structure was unconstitutional. And it took a long time for somebody to challenge it, mostly because companies realized they were not going to win, generally speaking, and they just kind of settled with the Bureau. But finally, one company stood up to them, and it got to the court. And basically, this is what the court said. They said, we have three branches of the government. The executive branch answers to the president, who's elected, and there are agencies like the FBI and the IRS who are executive branches. And the president, even though he doesn't very often, the president can fire the head of the Bureau of the agency because they control the agency. So in that way, the voters get to have their say because they elect the president who can get rid of the head of an agency. In the last 20, 25 years, they've had this other idea of an independent commission, like the Securities and Exchange Commission, where the idea was that you had a panel of experts, and they were independent, and the president couldn't fire them or affect them. The idea was to have it beyond politics, and normally you'd have two of one party and three of the other party, and like with the SEC, the chairman of the commission is picked by the party in power. So the party in power controls it, but there's an open discussion, there are open debates, there are two sides each other, and no one commissioner basically rules everything. And so this was really the first time, because of the CFPB structure and the president not being able to fire the director, that you had an independent single director agency as opposed to an independent commission. Mm-hmm. And what the court said was, you've now just taken it one step too far. And in fact, the court said, and really correctly so, that there's nobody else in the entire federal government as powerful as the director of the CFPB as it stood, because Supreme Court justices need to have four other justices vote with them. Everybody in Congress or the Senate needs to have other votes with them. There's really nobody other than the president who can single-handedly do almost whatever they want without getting fired. And in fact, said in consumer financial matters, the head of the CFPB might even be more powerful than the president because the president can't fire them. So the court said, well, fixed it. Basically, the courts try to kind of take the easiest way to fix something. So the court couldn't turn it into a commission without a huge amount of work or, new legislation, whatever. So basically what they said was the president can fire the head of the agency, the CFPB. And that was how the court fixed it. That was October 11th. Well, on October 11th, everybody said, well, that's not such a big deal because, when Hillary Clinton is president, she's obviously not going to fire the head of the CFPB. And then she'll appoint another Democrat, and then, and things will go on that way. So things won't change. Obviously, on November 8th, things changed.
Yeah. Let me ask you this. Are there areas that they did good work, that they benefited, they brought light to dark practices? Were there successes?
Oh, listen, there is a reason for this agency, and that's why I came to build it. I mean, there were things that needed to be fixed. And in fact, when I interviewed with Richard Cordray, who was at the time going to be the head of enforcement before he became was nominated and then recess appointed to be the head of the whole agency, he asked me in the interview, what do you think we should do first? And I said, there's a lot of really low-hanging fruit. For example, people who have credit in their credit reports, there's mistakes, and they get on the phone for 3 hours and they cannot get the mistake fixed. Like, there are things that need to be fixed. I mean, those credit card disclosures that are I couldn't even read them without a magnifying glass, that are pages long, that in fact were what Elizabeth Warren wrote about in her original article.
Did they fix them?
They're trying. I mean, some of those things are harder to do than you might think. So, for example, because too much disclosure becomes no disclosure. And so, for example, in mortgage documents, if anyone who's bought a home and, taken out a mortgage, they just keep putting papers in front of you. And, you want to know what's really important. What are the interest rate? What are the fees? It actually is a very hard problem to give people just enough information, the information they want, and do it on forms that somebody sneaky can't come in and go, okay, well, if that's what I need to do, I can stick this somewhere else, So, they're in the process of doing that, and they've put out, new forms, and I think what they've done so far, it's not perfect, and it can kind of evolve. Those are some of the things that I think are really good and important.
Now, if we look at other cases they were involved in, they went after car dealers for setting higher rates for minorities. And it's very fascinating because, first of all, they didn't have really statistics to back it up, but also car dealers were originally exempted, right, from the CFPB.
The one kind of loss that Elizabeth Warren and the Democrats had when they were writing the Dodd-Frank Act was car dealers. Car dealers, there's a car dealer in every congressional district, whether Democrat or Republican, and they have a very big voice in Washington. And so at the last minute, they got an exemption. They got a carve-out, and it's a complete carve-out. Basically, the CFPB can't go anywhere near car dealers. And it kind of gnawed, I think, at Elizabeth Warren and some of the Democrats. And the one thing that they couldn't have, they just wanted.
So are these people that are doing this, do they not understand business? Do they reflexively are against business? I mean, there's enough stuff out there without having to make up statistics like they were essentially doing.
Well, I mean, any number of combination of those. I wouldn't limit it to one, and I wouldn't say that there weren't people who but in general, I've always kind of thought that the kind of left-wing Democrats, that they think that economics is kind of a myth that we all made up to help rich people. That they just kind of seem to think that the math doesn't exist. So there's a lot of you can either call that willful denial or maybe lack of education. But then there had to be people who also just knew, for example, that the number guessing was just wrong. But they had basically, they were trying to do something and saying they were doing something else. They were basically trying to regulate car dealers and then doing so by claiming there was discrimination, which was the only way they could try to do it.
Pretty scary, actually. All right, we got about a minute and a half to go. Payday loans, which on the surface would seem like a perfect thing for them to go after, the 390% annualized rate for these 2-week loans that they do. But you say that the law of unintended consequences, popped up, and that CFPB may have done more damage than good.
Well, payday loans on the face of them, if you're kind of making a pitch, sound terrible. You say, well, this high interest rate, you've got people with bad credit, and you're ripping them off. But in fact, it's a perfect example of the free market and how the free market works, which is that people are not being deceived. People need those loans. People decide on their own that this is their best alternative. They don't have a chance to get a loan. Maybe they're going to have to pay overdraft fees if they don't get the loan. People know their individual circumstances. So they understand payday loans. And on top of that, there's very low barriers to entry into that business. So anybody with a little bit of money can put out a shingle and say, I'm going to do short-term loans. So there's no monopoly going on, which means that the price of the loans, if you charge too much, somebody's going to come along and charge a lower rate. So the loans are actually priced to what is, in effect, the cost, which is the risk of default and whatever it costs to kind of hang out put up a sign and have your own payday store. And
by the way, you're doing the kind of cost-benefit analysis that seemed to not exist in the rest of the agency.
Yeah, well, it's just that, by the way, in one of my articles, Richard Corday himself testified in front of Congress and said it's a very hard business to make money in. People, even though the rates on the face of them are high, people are not gouging because this is, given defaults and everything else it costs to offer these loans to people, this is the only way they can stay in business.
So basically, the payday loan investigation may have actually hurt the lower income folks that need it. We're going to be back with our final national segment. We'll talk about what should happen to the CFPB. And we're back for our final segment with Ron Rubin, who's written a very insider piece on the Consumer Financial Protection Bureau. We're going to talk now about what should happen to this agency, and I think you wanted to finish up on payday loans.
Yeah, so the bottom line of payday loans is if you have a better offer to make people, then sure. Then if you can figure out a way to offer loans to people at a lower interest rate, that's good. But just taking away their only source of credit without offering them something better is not helping them. And that's really kind of the problem, is that they hate the payday loans so much, and they hate the idea of this high interest rate so much that they're willing to take away loans that leave people high and dry without any other source of credit.
And that leads into a good place to finish this up. What should happen to the Consumer Financial Protection Bureau? It seems like we have an example of a mission that had no oversight, too much power, and ended up doing a lot of damage, perhaps inadvertently, or perhaps directly as a result of the fact that they narrowed the people that they had there. So tell us what should happen to the agency and what should happen to the current director, Richard Cordray.
Congress has basically been passing bills since 2011 to change mostly two things, which is give the funding back under the control of Congress, and make this into a bipartisan commission. And every time they tried to do it, the Democrats said, you just want to harm consumer protection. You don't care about consumer protection. So those are really the two major reforms that you can look at. The question of a commission, I mean, ultimately, if you want it to be independent, ultimately it should be a commission because, well, first of all, it would have to be under the recent Supreme Court, the Court of Appeals decision. Mm-hmm. It would if you wanted to take away the president's ability to remove members, the leaders, then it would have to be a commission, not a single director. If you're going to get there, personally, I think it's not a bad place to end up, but I think the Republicans now need some time to go in there and balance it out before we then, somewhere down the line, merge it into or morph it into a bipartisan commission.
And is that by that you mean like the SEC?
Yes. And again, since my experience for many years is at the SEC, I have to tell you, when I worked there, I was never even aware of which party was controlling the commission. There always seemed to me to be a very professional. The commissioners were knowledgeable. They may have had different perspectives, but that's the idea of a commission, is that you have a lot of experts, and the reason you're going to allow them to be independent is because they're experts, and they're going to be, operating in good faith. Ultimately. So
you think that you do not think it should be abolished?
Oh no, not. I mean, I think that there are real purposes for the agency. For example, before, one of the reasons you needed an agency like this was that the bank regulators, their first priority was always safety and soundness of the banks. And then, they didn't really focus on consumer protection. And in fact, if you think about it, higher fees, overdraft fees, even if maybe they're not so fair, mm-hmm. that kind of works in favor of safety and soundness because the banks are making more money. So there was kind of a built-in conflict of interest there, and a lot of consumer laws were not being properly enforced. But it needs, first of all, it needs to be not an all-powerful, vast, overreaching bureaucracy, which is what it is, and ultimately
that's a great point at the heart of your argument. Does it need to have the consumer advocacy need to be balanced with either fairness or at least the costs to business of doing this? I mean, how do you get them to have more of a perspective that that right now it's almost like business is bad, consumers are getting screwed?
Well, you know, the irony of it all is that a lot of the things, and if you look at most of my articles, I try not to write like, gosh, they're awful, they're bad, I don't like the agency, da-da-da. Generally, the punchline of my articles is what you're doing is actually hurting consumers. You're not even helping consumers. So, for example,
good point.
One of the things that they're working on is debt collection rules, and one of the proposals that may end up becoming in the rules, or at least if the rules go through, is that debtors are, the minute the debt collector calls, you can say, "I never want you to call me again." That's it. I'm in control of my debt collection. And, what ends up happening? People end up getting sued because if the debt collector can't talk to you, then the next step is to sue them. Or if you can't collect on debt, what happens? Ultimately, interest rates go up because the cost has to be passed on. And so...
Yeah, that's the part that's missing, right, from the agency or the Bureau.
Well, that's economics. I mean, and in a lot of ways, economics is a difference between short-term and long-term thinking. And, so there needs to be a kind of a fuller perspective. It doesn't need to be like, I'm your class action lawyer and I'm going to just get everything I can for you today. Consumer protection doesn't mean necessarily consumer advocacy. There's a real difference there. One is law enforcement and the other is basically advocacy for your client.
Interesting. Let me ask you this. Trump is about to take over, and of course he ran The Apprentice where he issued "You're fired." Should the director, Cordray, be fired?
I mean, personally, I don't like to see a good person be fired, whether or not they've done a good job or not.
Has he done a good job?
He's done some things well and some things not well. But, I would also say in general, I read somewhere once that nobody should ever have the same job for more than 5 years. And the director job was supposed to be a 5-year job, but because he was first recess appointed and was in a recess appointment for a year and a half, and then, before his full term came, at this point he's been almost 6 years. He's been at the agency, for 6 years, but he was nominated, was it January of 2012? So now we're coming up on 5 years. Once he was nominated, for all intents and purposes, even though he officially wasn't running the agency, he was. And then once the recess appointment was in January of 2012. So he actually has been, running things for more than 5 years.
Thanks to Ron Rubin. He's taken a very gutsy, I guess, our overall interest look at the Consumer Financial Protection Bureau. And you could read the article in the National Review, "The Tragic Downfall of the Consumer Financial Protection Bureau." You've been listening to Business Talk with Jim Campbell. Thanks to Ron Rubin. Thanks to our national audience for listening. And we'll see everybody next Sunday on Business Talk with Jim Campbell. And Ron Rubin nicely has agreed to stay with us here on Segment 5, Overtime. More on the Consumer Financial Protection Bureau. And, of course, our timing is right on the inauguration of President Trump, and it's starting to surface the CFPB already. First off, Ron, thanks for staying with us. And have you had, what's been the response to your CFPB article? I know you've had a lot of activity online, people looking at it. Tell us the response.
It's certainly been the highest response of anything I've ever written, although my first article about the Wolf of Wall Street, which was in the Wall Street Journal, got a lot of readership just because of the platform and because it was a movie. But it's just been unbelievable, and it just keeps going. I mean, I've had thousands of people sharing it on Facebook and LinkedIn, and coming kind of in toward me. I've had a lot of employees who I didn't know calling and kind of thanking me and saying we're miserable. We're so happy to hear that somebody is recognizing this, as well as some very interesting contact from businesses who are being investigated who said, this is wonderful to hear that somebody else is going through this nightmare that we're going through, and maybe there's some hope for us that we'll get fair treatment at some point. And then there have been several articles written about it. The Wall Street Journal mentioned it and linked to it in one of their news articles, which obviously got a lot of people to read it. And then there have been a couple of Wall Street Journal op-eds that I could kind of tell very clearly, had read what I had written, and obviously in much shorter form discussed the same issues. And then there was a Housing Wire article that said basically a former CFPB attorney confirms what we all suspected about how their investigations run. So it's really been great to kind of get that many readers, and I think the reason is that nobody really speaks about what really goes on inside the Consumer Financial Protection Bureau, and there are so many thousands of industry workers and people who deal with the CFPB who are interested. One very interesting contact I got was from a consumer who was very frustrated because their house was being foreclosed on, and they kept calling Consumer Response, and they said, I don't understand. This is the agency that's supposed to help me. How come nobody is helping me? And I had to explain to the woman that they, by their own terms, they don't help individual consumers. They just take complaints, and then the way the system is supposed to work, if they get enough complaints, then they investigate something, but they really don't do a whole lot to help somebody in that kind of situation.
And I might say that we're very appreciative you brought this to our show. I've seen some of the reaction in the Wall Street Journal, too, where now your article is sort of the base thing that there's a link to from every article on this subject. What I want to move to now with the incoming administration, there is already a formal GOP effort to oust the head of the CFPB, which is Richard Cordray. And you in the show earlier, basically were along the lines of, his time should be up. What do you think about this effort and this initial focus on Cordray?
Well, I go back to what I had said earlier in the show. It's not that I'm particularly calling for his removal in one sense or another. It's that between his recess appointment time and the time that he's served after he was confirmed, he's now been in that office for 5 years. So it's a 5-year term, and the only reason it's extended or could extend beyond that was because there was this period of time where he was the head of the agency as a recess appointee, and that later that appointment would have been found unconstitutional. So it's not really like it would be tremendously unfair. It would be that he would have served 5 years, which was the length of the term. But initially, and I think maybe before my article, a lot of the focus was on the PHH decision, the Second Circuit Court of Appeals. The D.C. Court of Appeals decision that said that the president could remove the director of the CFPB at will. But there always was a possibility of removing the director for cause. And so now there's a lot of focus on that part of basically saying, regardless of what the status is of the PHH appeal, there's grounds to remove the director for cause. So two senators, Sasse and Lee, called on President Trump to remove the director for cause. And then just this week, former Congressman Randy Neugebauer, who was on the House Financial Services Committee, was subcommittee chairman for financial institutions, if I remember correctly. He met with President Trump and wasn't in secret, and as a potential new director for the Consumer Financial Protection Bureau. So obviously, if President Trump is interviewing replacements, there's a good chance that he will try to remove Director Cordray.
Interesting when you say that there are replacement candidates, because obviously they're going to be reflective of a more conservative Republican philosophy. But as you talked about in the initial segments, the place is staffed almost 100%, except for when you were there, with liberal Democrats, often folks who've never had any ounce of business, even relationship. Do you think that would the organism reject someone like that?
Well, it's happened before. I had a friend who was actually a Democrat, who was the head of a lesser-known agency, and he came in with a Democratic administration, and he said, he thought he would kind of walk in the door and suddenly things would be, his way, and he said, you get middle managers and employees, and you they have civil service protection, and you can't just walk in and fire them. And so he said he found that there was a lot of resistance to what he wanted to do, that he couldn't just walk in and do whatever he wanted to do. So, I think one of the questions you asked me last time was, what I think should happen, and should it be a commission? Ultimately, I think it should be a commission, but I think that you would need to have a period of time where it was run by a Republican so that when you got to the commission stage, it would be more balanced out, as opposed to what the person I was just telling you about, my friend, experienced kind of going in. So I would expect that there would be quite a bit of resistance. Certainly, if it was one person at the head of an organization that was entirely against him, it would be very difficult. Of course, that kind of if you do bring in a new director of the other party, they would very quickly hire at least some senior management who were conservative or thinking along the same lines as the new leader.
Let me ask, one of the criticisms that's coming out of this GOP effort already is that the CFPB has put undue burden on credit unions and community banks, the smaller sector. What does that mean exactly? What evidence have you seen of that?
Well, when you put in rules that create a huge amount of compliance and, more, work, basically non-income or non-revenue earning employees, it's very difficult for smaller organizations because they're not writing off that expense over a larger base of business. So from the very beginning, smaller banks and community banks were really feeling the pain, and they expressed it a lot through their representatives, and it was a kind of protest against the Consumer Financial Protection Bureau that was much better received than others, because Democrats have a lot of small banks and community banks in their districts, and generally speaking, there's more sympathy for smaller banks and smaller institutions, whereas we tend to kind of demonize the larger banks. So unfortunately, I think many of them have already closed, and once they've closed, I don't know how easily they can reopen. But that would probably be one of the earlier focuses would be to try to address those concerns as quickly as possible. So,
in other words, you do think that's legitimate? Because I know you said that they tended to target large just because of size, and that's where the money was, as opposed to if that was the most egregious area. But they did put burden on this end of the market as well. Well, that's for investigations, but for rulemaking,
I got it. For rulemaking and on all of the kind of new compliance that came into place, that was across the board, and even by targeting the larger institutions, especially the better run and kind of more forward-thinking smaller institutions didn't know that they were not going to be investigated, so they saw what was going on with those large examples in investigations, and they said, we better make sure we're doing everything right. So it's a matter of that kind of second part is what is often referred to as rulemaking by enforcement, where they do some kind of enforcement action, and it has the effect of a rule because everyone in the industry sees what happened, and they don't want to be the next subject of an enforcement action.
Okay, so is it your feeling that Trump could just himself, executive action, replace Cordray?
Well, there are two questions as far as removal goes. One is, would it stand up? At the end of the day, is there really grounds for removal? And then the second is there arguable grounds for removal? In other words, could you do it with a straight face or, in good faith? And because it's something that happens so rarely, the second question is very difficult to answer. Where would you end up eventually? Because there's just so little legal precedent. I'm trying to remember, but the last time it's been decades since a president tried to remove a head of an agency for cause, and I think it's only happened something like 2 or 3 times ever. So the final outcome is kind of hard to say. But I think it's pretty clear that it could be done in good faith. Some of the points raised in my article, and then in, let's say, Senator Sassy and Lee's letter, actually brought even more, things that were not even in my article. And then, of course, there are many things that are not even public. So the focus on removal by the media has focused on these discrimination issues only because those were the ones that got the most publicity. And when journalists go to speak to CFPB employees, or the ones who will speak to them, generally they're the union people, and generally the first thing that they talk about are these discrimination issues and other union issues. So that's kind of the message that's gotten through to the media, but it's not necessarily the issues that would be the focus of some kind of a removal effort.
Do you think there's a chance that this focus on getting rid of Cordray it might be a stalking horse for ultimately abolishing the CFPB?
I don't think so. I think it's generally a politically popular concept. I think that a lot of people are not happy the way it's been executed, basically that it has been a political rather than a professional agency. But there always was a function for this agency, and I think that I don't see that as being the focus. I think that if legislatively, if that was the focus, I think you would have probably been hearing for that. I mean, what is it? I guess on day one or even before, Republicans are going to try to repeal Obamacare, and you haven't really, you've heard repeals of parts of Dodd-Frank, but in reality, you don't hear so much. Just wipe the whole thing out.
Okay, well, this is a good segue into what are initiatives or things that they could be focusing on to help fulfill their mission. One of the things that, at the core of your point is that they have not fulfilled their mission. Let's talk about some of those. And one that's I like, because I've been on Wall Street, and as an example, is that, consumers often find out they're forced into arbitration by industry-friendly arbiters, essentially arbitrators. Talk about that.
Yeah, I mean, arbitration is a real problem. The New York Times did a series of articles on it about a year ago. The concept itself is a very good and very important concept, which is not driving everybody to the courts, especially when you have small claims where no individual consumer would be able to sue on their own. And so, arbitration in general is a good concept. The problem is that the arbitrators themselves are chosen by industry, and if you're an arbitrator and you want to be chosen again and you want to be on the list of potential arbitrators, you are very biased toward industry. So it's not the concept of arbitration that's the problem. It's the fact that arbitration in practice isn't really the equivalent of a fair trial. And so the CFPB's kind of reaction has been to go to the other extreme, to more or less get rid of arbitration. I mean, the CFPB, for example, in payday lending, they don't pass rules that just make it go away. They pass rules that look like they're rules, but in practice make it go away. So basically eliminating arbitration, I think, would really hurt consumers because, on the whole, it would raise businesses' costs and costs to consumers. So what really needs to be done is an intelligent look at how you can keep arbitration, but make it so that it really is fair. And, the ways of doing so really probably aren't that complicated. For example, you have some kind of a general pool of arbitrators, and you don't give either businesses or, class action lawyers who the kind of people on the other side who understand who the arbitrators are, you don't give them as much say in who the arbitrators are, so that you, like when you go for a jury trial, you don't know who's going to be in the jury pool, and that ensures as much as possible fairness of the process.
We talked about the unintended consequences of payday lending before, that actually it was hurting by cutting off credit. What are some good things that they could do or are trying to do there?
As far as new rules coming, or?
Yeah, on payday lending.
Well, on payday lending, again, this is probably as high on the list of things that I have found objectionable that the Bureau has done, because it's really based on almost emotion rather than economics. And so that's an area where they've been more or less, payday lending, generally speaking, is a very honest industry. It's portrayed as being a bunch of greedy, evil people. But if you actually ask the customers of payday lenders, they actually really love the product. And most of the objection comes from, the kind of academics and people who look and don't really understand what it's like. And so just eliminating what for many people is their only form of credit without really intelligently thinking about what are they going to do next is just very bad policy and very harmful to consumers. So, the CFPB, if you go back to the very beginning of the concept that Elizabeth Warren raised in 2007, it was that people understand their financial products, that they're not being cheated, that they're not being deceived. But it was never interference with the market. It was always making the market work better as opposed to making the market work the way you think it should work and have products that you think it should have. So I honestly, there's not a whole lot in that payday rulemaking that I think is beneficial.
It's interesting to me that, the more we look into the various areas where they think they're doing good, we end up with all these unintended consequences. I don't know if one thing they should do is mix some sort of a business function or something so that when they look at things, they're forced to do cost-benefit and understand whether there's unintended consequences or not, because all these good intentions don't seem to really be coming to the fruition.
Well, if you look at the Dodd-Frank Act, which I'm afraid I haven't done this morning, so I'm going off the top of my head. But I believe that, one of the two objectives were supposed to be maintaining good credit to people. So there really hasn't been this balancing of, keeping things honest and keeping credit good. It's that part of the equation has almost been ignored. It's very, very important that you have unbiased economists in-house who are, really looking at beyond step one. Okay, well, if we do this today, what happens tomorrow, and how does that affect consumers and the market? So, unintended consequences are always the downside of legislation, but especially legislation or rulemaking or regulation that interferes with the market mechanism. You always have to anticipate, what's going to happen next, not just what happens on day one.
We're down to the last couple of minutes. It would seem, Ron, that you have diagnosed and have answers that are probably better than almost anybody coming from the inside. If this person is brought in to succeed Richard Cordray, would you jump on board if you're called on?
I absolutely would, and I'm not pitching for a job, but I have to tell you, having been there so early at the agency and having seen how optimistic it was and how much promise it had, and then seeing the way it went, there's just something in me that very much wants to bring that back and fix it and make it what it could have been. And so if there's anything that I can do to help that, I absolutely would, because I think that if done properly, the agency could really be a good agency, and it just needs to be taken from being a really almost purely political organization to being a professional organization that is basically built to last. I mean, political organizations are never built to last because, as we've just seen, politics change.
Very interesting, because one of the benefits of Trump is that he seems open to looking at reforming all these agencies and getting people wherever they can come from to do it, as opposed to just the political channel of the loyal party stuff. I want to thank Ron Rubin for staying with us for the full hour. That article, again, that's getting virally spread around the net, The Tragic Downfall of the Consumer Financial Protection Bureau, National Review. This has been Business Talk with Jim Campbell. Our next show, we're going inside Silicon Valley. with Wall Street Journal reporter Alexandra Wolf. And then the third in our series of advice for the incoming Trump administration shows. We've had experts tackle Syrian strategy and education, a call for school choice there. We've done the CFPB. Next, we've got a recommendation for turning the anachronistic Department of Labor into the Workforce Department, focusing on matching skills with jobs. Thanks to Ron Rubin. See everybody next Sunday on Business Talk with Jim Campbell.